because you can, you can be right about the direction of the stock and be wrong about the volatility and still lose money on your option trade. I'm sure most of you have heard that before, but I like to really drive that in. And on the same, the other side of the coin is if you're trading using options to trade the volatility, you still have to be aware of the direction. At least be aware of where the stock might go and what your price range is for your profit. So the two, volatility and price, when you're using options, are really tightly coupled. Okay, so now we'll switch to the live demonstration, and I will go to the strategy zone to start with. Wait, there we go. Okay, I'm monitoring the presentation on my laptop here. So what I've done is I pulled up the strategy zone commentary site. Just as a quick history of how Option Workbench was started, in 2008 I enrolled in the Macmillan mentoring program, the option trading mentoring program, which is very good. Stan Freifeld runs that. He's a really bright guy. He knows the math inside out, upside down, frontwards, backwards, sideways, however you want to do it. And he spent a lot of time on the trading floor, so he knows the trading part of it too. He's got a good intuitive sense for the trading as well as a quantitative sense for how options work. And I was talking to him earlier, and he taught me a valuable lesson tonight. So he's still mentoring me. So I enrolled in the mentoring program, and part of the program was introducing me to the strategy zone. And what that is the Macmillan Analysis Corp online database of option data. And for the purposes of Option Workbench, we'll divide that into three sections. First being volatility data, which are contained in the volatility extremes, the skewing, the volatility history file. There's market data, which is contained in the Greeks files, and that has pricing data for all the underlyings and option securities. And then finally, what I call spread profiles, and those are the covered calls, straddle buys, calendars, and naked puts. And just because we need a definition, we'll define a spread as anything with one or more option legs and possibly an underlying. Now there's there's an abundance of really good data here. It's a little bit hard to navigate around, and I'll do a quick example to show that, and this will help you understand why I started developing Option Workbench for myself. And then it led to me showing it to Stan, and then Stan talking to Larry, and then a few years later, here we are. So I went through the mentoring program, and Stan and I were talking about volatility skews and the concept of the composite implied volatility and whether the options are in an extremely low. If the composite IV is low, in a low percentile, the options were cheap. If it's in a high percentile, the options are expensive. So what I did was I went on the strategy zone, I clicked on volatility skewing, and I opened the file. I'll open the file from yesterday, and as you can see, what you get here is a file full of symbols and numbers, and they have them sorted in different ways. In this case, I clicked sort by alphabetically. Actually, what I actually did was I clicked on the sort by standard deviation. So I'll do that one. So now we have the most expensive, the most expensive options on top. And I found something that I was interested in. I'm going to look for what we're going to talk about a little bit later, which is Goldman Sachs. Just something I picked out for an example. And so here's the volatility skew information for Goldman Sachs. And then I said, okay, well, there's the skew. And I went and looked to see if it was in an extreme. And actually, tonight, today at Goldman Sachs is not an extreme. But I wanted to know what the skew, whether it was a horizontal skew or a vertical skew, what strikes was it, what months was it. And so I sent an email to info@optionstrategist, which is the general helpline, the help email for Macmillan Analysis. And Larry himself actually answered me pretty quickly. He said, well, you just go to the Greeks file, and you find it in the Greeks file, and then you look at the numbers in there, and you can see where the skew is. So now the Greeks file is very big. It takes a little bit of time to load sometimes. But you can see that this file is also an even bigger file of just a lot of numbers. So the first thing I did was I started writing a program for myself to organize this data on a different axis, basically taking a cross-section of the data that are in all these volatility history files, volatility data files, excuse me. There's one other one that's in here, the unusual activity. I've integrated the unusual volume file, which some of you might get Larry's daily volume alerts. That data comes from this file here. So what I really wanted was a cross-section of all those files by symbol, so then I could sort and filter the data by the data in the different files by symbol, and then be able to zero in on opportunities much faster. So what I came up with was Option Workbench. And wait for it to come up. There we go. And when you first open Option Workbench, you're presented with this, what I call a dashboard screen. What we have on here is today's commentary from the strategy zone. The left side is the navigation panel. Up here is what I call the profile date, and that is we're actually looking at yesterday's closed data. Today's data is not yet available. It's usually there by 5 a.m. I'm an early riser, and I get up usually between 5 and 5:30, and the data is there, ready and waiting for me. And I start my analysis for the day. So we're dealing with the profile date of June 11th and today's trade date of June 12th. You have the risk-free rate, which is basically the 90-day T-bill rate. That's what's used in the Black-Scholes calculations that go on inside Option Workbench. And you can change that to something else if you don't want it. And the overall idea of the dashboard is to give you a general feeling of where the market is trading in terms of volatility and prices. And what where you can get that idea is from these two charts. This chart on the left is the IB percentile histogram. And what that shows is each of the blue bars shows how many, in this case, equities and ETFs are in a specific percentile. So if I hover the mouse over this 61st percentile, I can see that 1.8% of all equities and ETFs are in the 61st percentile, and cumulatively 47.5% almost of all equities and ETFs are at or below the 61st percentile. And usually what I like to do is find where the mean is. In this case, it's between the 63rd and 64th. And what that says is half of all the composite IVs are at or above the 64th percentile. So what that says just right away is that options are pretty expensive now. And of course, this data is based on on Monday's big downturn. And if we look at it tomorrow morning, this skew, the histogram will be shifted a little bit more to the left. But if you're paying attention to VIX today, it didn't really go down that much. Even with the big rally, VIX was over 22 at the close today. So I suspect that this histogram isn't going to be shifted all that far to the left tomorrow. tomorrow morning. And on the right here is the VIX term structure. And if you get any of Larry's newsletters, he talks a lot about the slope of the term structure. And this upward slope is indicative of a bull market. So there are some sort of mixed signals, and he's been talking about that. On the one hand, the volatility is high, VIX is high, which means people are buying a lot of protection, a lot of puts to protect themselves, probably. But on the other hand, the futures are saying that the current volatility is low, so that's indicative of a bullish market. And Larry has a better explanation for this than I do, but I'll leave that to him to explain. Okay, so for the purposes of this demonstration, since volatility is high after yesterday's downturn and high in general, I want to try to take advantage of the high volatility and sell some volatility, sell some options to take advantage of the high premium. And the way I'm going to do that is I'll click on the equity and ETF option profiles. They're separated by the underlying asset class a little bit. So you have equities and ETFs, you have indexes and futures. And I won't really go into futures and equity indexes tonight. Just mostly I'll stick with the equities and ETFs. So the first thing that we see here is the option profile table, and actually I'll click on this arrow so we get a little bit more real estate. And what we have here is a table where the rows are by symbol and the columns give you that cross-section that I was talking about earlier. So at the left side here are just some general information about the stock, the symbol. If I hover over the symbol, I get a little description of what the stock is. I get the closing price. This last traded is actually the last time that the composite implied volatility was able to be calculated. And the composite implied volatility and what the current percentile is. The next section are the spread profiles that are covered on the strategy zone, and that's the calendars, cover calls, naked puts, and straddle buys. And in this case, there are no calendars for Agilent Technologies. There are 45 covered calls and 36 naked puts covered in the strategy zone. So a blank column there means that there's nothing in those spread profiles, those spread files on the strategy zone. The next section shows option volume. So you have call volume, put volume, and total volume. And then if we scroll down here, or look down here at TK, which is TK Corp. Okay, that's a good symbol. You can see a number in this average volume column. And what that means is that this symbol appears in the unusual volume report. So the average volume over the last 20 days, I think it is, was just over 2,000 contracts. And yesterday it traded 12,000 contracts, most of those in calls. So this could be some kind of takeover, or I'm not sure what this company does, but in all likelihood it's a takeover or some kind of other impending corporate action that's causing people to load up on these calls. The next column after the average volume is the IV factor, and what that tells you is a percentage premium or discount over the composite implied volatility, or the average composite implied volatility for the last 20 days that today's composite implied volatility is at. So today's 41.6 composite IV is 4% more or higher than the previous 20 days. And you can see now that it's in the 84th percentile, and that usually qualifies it to be in the volatility extremes file, but in this case it's not. The next section is the historical volatility. Everything has a 20, 50, and 100-day historical volatility. And the next section is the percentiles. So this symbol SYY, Cisco Corp, is in the volatility extremes file. And what these numbers tell you is if the composite implied volatility was 13%, it would be in the 10th percentile. And we can see that it's 13.9, and it's in the 13th percentile. If it was 15%, it would be in the 20th percentile, et cetera, et cetera. And this gives you sort of an indication of how wide the range of the composite implied volatility is. So if you're going to do a long or short volatility trade, you want this range to be kind of wide so the option volatility has room to move around. So if it's low, you want it to be able to go higher, and if it's high and you're selling, you want it to be able to go lower, and you want it to have a good distance to be able to move. The next column is it's called Vol IV. It's really the standard deviation of all the option implied volatilities for that option class, and or that class of options. And with that contributes to the calculation of the skew, which is the final column. And a number, there's always a number in the skew column. A number in the regular font indicates that this stock, for example, VMware, is in the volatility skewing file and has a skew of 10.1 or 10.2%. In reality, there's always a skew that you can measure. It's just not always very big. And what that is, it's this standard deviation of the implied volatilities divided by the composite IV. So these numbers that are grayed out are numbers that Option Workbench puts in there just so you can know what the skew is. And kind of hard to read on the presentation, but if you have it on your live screen, it's a little bit easier to read. Now, what you use the skew for, someone asked a question, which is a good question, segues right into here, is to decide if there's enough room for movement in the implied volatility to warrant you trying to sell or buy the volatility. It measures the dispersion of the volatilities for the options on that underlying. We'll see a little bit more about it in a couple of minutes. So you can see at the bottom left of the screen here, we're looking at 2,426 out of 3,532 equities and ETFs that are covered on the strategy zone with options. So there's a lot to choose from, and in fact, there are over 400,000 options available for you to trade. So the first thing we really want to do is to be able to sort and filter these columns so we can zero in on a trading opportunity. A couple of people have asked about the vertical spreads. There aren't any vertical spreads in the strategy zone, but we'll see a little bit later how to compare how to do vertical spreads. Okay. So what I want to do, the first filter that's here already is this last trade date, and that's the reason that we're only looking at 2,400 out of the 3,500. We've filtered out 1,100 of them that just don't trade regularly enough to be able to have their composite IV calculated. But we can add those in if we click on this drop down. Let's say we go back to last week. So now we've added a couple of hundred more actually. We have 2,600, and we can see this one, FXCM. Not sure what that is, but it only trades 38 contracts. So this filter really is useful for liquidity. as a first liquidity filter. I don't really want to get into a position where I have all the open interest, and I won't be able to unwind the position. Another way to filter is you can just type in a symbol. Lots of people like Apple, so you can type Apple in there, and you can zero in right on Apple's data. So you can see, just taking a look at it, Apple's about in the middle. It's a 57th percentile. Trades lots of options. Not in any of the unusual, not in really any of the reports. So there's probably nothing unusual going on with Apple. If you don't know the full symbol, you can use that starts with, say I know it starts with AA. I can find all the symbols that start with AA and look at the one that I'm interested in. So that's just those are two quick filters. But the real power here is in these the filter formulas. Now each column, if I hover over it, you'll pop up a description of the field, and then give you the filter field name. And what that is a name that you can type in to the filter formula and do a comparison on all the rows in that column to filter out or find the one that you're looking for. So each column has a name and a filter field formula and a description. Some of them are longer than others. At this time, you can only filter on the numeric columns. The reason for the symbol filter is because you can't filter on the symbol column. So the first thing I want to do is, I said earlier, let me go just to make sure, the mean is around here at 64th percentile. So if I want to find expensive options, oops. First thing I can do is filter on that 63rd percentile, and I built up this formula before, so I'll just step through it now. And then we can see we were looking at 2,500, 2,400 before. Now we're looking at 1,200. So we've knocked out half of what we were looking at, which makes sense because we're looking at things that are greater than the mean, than the half the options are more expensive than the 63rd percentile. So we still have 1,200 options to look at, or 1,200 underlyings with all their options to look at, and that's still kind of a lot. So what you can do is you can also use arithmetic expressions. And what I did here, I forgot to mention, these filters are designed to look like Excel formulas. So most people are familiar with Excel. If you have any kind of work in spreadsheets, you should be familiar with the formulas. So I use the AND function to combine these two formulas. So what this is saying is I only want to see rows where the IV percentile is greater than 63, and the composite IV, which is this column, divided by the 20-day historical volatility is greater than 1. And what that tells me is that the composite IV is at a premium to the actual realized volatility, which when I'm selling volatility is what I want to see. But we're still looking at 873 stocks here, which is still too much. So I'm going to add another filter. I want to see only things where the volume is greater than 1,000 contracts. This way I know I can get in and out quickly if I want to. And now we're down to 202. Now here's where we can start using the skew. So I want a skew of greater than 10%, which usually qualifies something to be in the skewing file. And what that means is that there's enough of a dispersion in the option prices, either vertical or horizontal, we actually don't know yet, that if I sell options or buy options, there's going to be enough room for them to move between the trade date, or today, and the expiration date. So I have a good chance of making money on the volatility move. But there's still 115 of them, so I put a little bit of price filter in there. So I want stocks that are greater than $20 and less than $200. And that gave me a little bit more of a screen of a filtering. I cannot see the bottom of the window. Okay, someone is. I'll just shrink that a little bit. Someone is saying that they can't see the bottom. Most of the action happens at the top here right now anyway. The bottom is just stuff that's being filtered out. So these filters are dynamic, and you can put in anything that you want, and it automatically saves what you type in here. So you can go back and refer to them later. There aren't really any out-of-the-box filters, mainly because market conditions change. And today I'm looking at selling, selling options because volatility is high. Maybe I'm bullish on the market, so I want to find something that I can play as a little bit more on the something that I can play on the upside to the market. I'm not saying any of that is true, or I'm making any recommendations, but those are reasons why you want to have dynamic filters. In the near future, I'm not sure exactly where it is on the development queue. I'm going to be changing around this how you manage the filters. You'll be able to name them and call them up by name, and have a little bit more flexibility in how you manage the filters. Okay, so now we still have 93 options here. So what I did was I tweaked the filter a little bit, and in this case I said, all right, I want a 10% premium over at least a 10% premium for the composite IV over the historical volatility, and that gave me 61. I usually like to narrow it down to about between 20 and 30, just a screen full, so I can see see one screen full at a time. So I played with different ways of doing this, and I'll just go to what I finally did, which was 15% skew and a 10% premium. And so now I have 37 of them, and that is kind of manageable. All right, so now I have a universe of things that I want to look at, and I can start sorting the data too. So I want to see things with the highest skew. So if I click on skew once, it sorts them in ascending order, and if I click on it again, it's going to sort them in descending order. So now I have options with stocks and ETFs with the highest skew on the top going down to the lowest skew. And then if I'm looking at selling options, I want it to be in the highest percentile possible. So I'll click on that one twice. So now I have them sorted from the highest percentile, which would be the most expensive options, down to the lowest percentile. And it also remembers the sorting. So if we look at these three rows that are in the 79th percentile, at the skew column, they're still sort of descending within that column. And then the next two on the 78 and on the 76th percentile. So now I have an idea of something that I might want to look at. And in this case, I chose Goldman Sachs. I skipped some of these ones on the top, like Eli Lilly, and it looks like there's some energy and healthcare stocks up here. I wanted to stay away from the healthcares because the Supreme Court is coming out with that decision sometime in the next couple of weeks. Definitely by the end of the month because they're going on vacation. So this is not. I mean, I would think about playing that, but not in this case. So I skipped down here to Goldman Sachs, which is something that most people will recognize. And what I did was, let me just go back here for a second. I put the mouse over the symbol and I clicked on it. You can see that the cursor changes to the little link hand cursor. And when I did that, Option Workbench loaded the data for Goldman Sachs, the details for Goldman Sachs, and brought me to this this detail area. So now we're going to really get into the meat of doing the comparison. So first, we covered searching for opportunities, which I should have mentioned earlier. The main purpose of Option Workbench is threefold: to quickly find opportunities, compare strategies different strategies that you can use to take advantage of those opportunities, and do risk analysis. Because, like I said before, you really, whenever you're trading options, no matter what your purpose is, you have to be aware of both price movement and volatility, and time as well. All the inputs to the Black-Scholes model. So the first page that we see here is the pricing sheet. Now, I don't know who everybody's broker is here, but for the most part, when you have a broker screen, you have calls on the left, puts on the right, a month worth of strike, usually a handful, then you can expand it. If you want to look at another month, you have to expand it. And you have kind of limited real estate as to what different different fields you can look at. So I put together this matrix format. It was really inspired by something that Stan showed me in the mentoring program that he used when he was on the trading floor. His was a piece of paper. This is very dynamic. And we'll see how dynamic it is in a minute. So what happens is it picks the nearest to the money strike, and then one strike on either side, and displays those strikes on this vertical side here. And then going across, you have on the columns, you have all the expiration dates with the calls and puts and bids and asks, and then all the implied volatility, the volume, and all the Greeks. So you can see that there's a lot of data. You get to look at a lot of data in one place here, and you can change the strikes that you're looking at by clicking on that strike screen. We can put some more strikes in there. Don't really want to deal with these Junes. They're expiring this week, so I'll take those away. And now I can see a bunch of different data, and I can start to look at the implied volatility to try to see where the skew might be. So I can look across here at the monies. They're pretty much the same. There's a couple of points difference between the Julys and Octobers, but it looks like there's more of a skew, more of a vertical skew in the Julys here. And I did the expiration dates. Okay. A better way probably to look at this is graphically. So we have the implied volatility analysis screen, which shows you what the skew looks like in a graph, like a volatility smile graph. And you can do the same thing with the expiration dates and the strikes. By default, it picks the first 4 strike, or up to 4 months, expiration months. So I got rid of those Junes, and now we can start to see that there is a kind of a vertical skew here. By default, it shows the average of the put and call volume, but you can change that to just puts or just calls, so you can get a better idea. It looks like there's a little bit of a horizontal skew as well in the calls. Not terribly big, but there nonetheless. And you can expand the strike range on both sides if you want. That gives you a little information about the volatility skew. The next part of the details is something that's, as far as I know, absolutely unique to Option Workbench, which is called the volatility study. And this chart, what it shows you is the red line here is the closing price. In this case, we're going back 1 year from June 11th. The blue bars are how much the price changed on that day in terms of standard deviations based on the historical volatility. So if I hover over here, a pop-up comes up, and the data is also presented in on the top, and it moves around as I move the cursor around. But we can see that on August 10th, the price closed at 108.73. It was down by 4.3 standard deviations. I guess that's, what am I doing? Here we go. 4.3 standard deviations. Go a little bit over to the right. The historical volatility was 53.07%, and the composite IV was 69%. Now that dollar value in the middle tells you how much a 4.3 standard deviation move would be in terms of today's historical 20-day historical volatility. So that would translate to a $6.91 move if Goldman Sachs changed by 4.3 standard deviations today. On the lower chart, we have the green line, which is the historical volatility, and the orange line, which is the composite implied volatility. So you can get an idea of where these are trading relative to each other and where they've been in the past. And you can also go back, lengthen the time frame, as well as change the study length for the historical volatility to 50 or 100 days. Now, another useful feature of this is you can look at details of data in the past. What I usually use this for is if I'm doing an earnings trade. So, I'll pick one of these spikes. I'm not sure if it was an earnings date, April 12th. Let's say it sounds like it was close to earnings. So I'll pick April 12th on the calendar down here, and there's a line that gets marked on here, and the data for April 12th is displayed in the table. And you can go back, to any other date. I can go back here to August 10th, 2011. If I click on the calendar, that's this date here, and it marks up the chart with a line and tells you, what all the data is. And you can also see, in general, if you see the blue underline, it's like a web browser where you can hover over it and click, and it'll take you somewhere else. And anywhere you see an X like this, I should also point out that I'm displaying this on my my Mac tonight, so it'll look a little bit different on a Windows machine, but it behaves the same way. So the X over here in the first column is if I want to get rid of that date. And I just click the X, and that row disappears from the table. And in this case, when I click on the date, it brings me back to the volatility analysis, and now it's loading the data for April, a window around that date. By default, it picks a month before, a week before, a day before, a day after, a week after, and a month after. So as I said, this I usually use this around an earnings period, and I think I guessed pretty well that this was around an earnings because we can see that the week before, the day before, there was quite a bit of a skew. Or I'm here, so I probably missed a day by a couple of days. They probably announced on the 13th because this is where the skew is most pronounced. But this gives you a little bit of a slideshow of what the volatility smile looked like around a specific date. And you can pick as many dates as you want. You can also pick dates in here. So I'm thinking that the earnings happened on the 13th. So let's go back and 13th. Let's look at the 14th. Oh, that's the weekend. Look at the 16th. It's still there. Okay, I skipped around the date somewhat. I don't want to spend too much time on that because that's not really what I'm here to talk about tonight. We also have the put-call ratio chart. This is the not weighted, the standard put-call ratio. I don't really use that too much, but the data is there, so it's presented. And now we can get into one more go back to the main page. So as I said before, we can see that there are 17 naked puts recommended in the strategy zone for Goldman Sachs. So now if I click on this 17, it brings me to the naked put profile page with all the columns from the naked put file, and it automatically put in the Goldman Sachs filter, so I can see all 17 naked puts that are on the strategy zone for Goldman Sachs. I can also put filters in here to filter down what I'm looking at, and these are other filters that I've been using. I probably will, yeah. So I click on that filter, and all the Goldman things disappear because it didn't qualify for any of these filters. But what I was looking at before and was this July 75 put. And I click on that, and it brings me back into the spread analysis page with that July 75 short put in there for analysis. And this is where we get into the comparing strategies and doing scenario analysis. Okay, it's 10 to 9. I'm a little slow here. So the table on top shows you the general values for that spread. In this case, it's the naked put. We get it for 67 cents, so the cost is a 67-cent credit. The implied volatility of the short is 51%. The IV factor, which again is the implied volatility divided by the composite IV, so you can see, 51 is way greater, is actually 40% greater than the 36.5% composite IV. So that tells us we're selling expensive options, which is good. That's what we want to do. You have the expected profit, which is the expected profit is the statistical measure of if we did this trade over and over and over and again, what will we expect to make on average? So on average, we would expect to make $641 if we could do this an infinite number of times. The expected risk is what do we expect as the margin in this case, because it's a naked put. What will we expect the margin to be over those infinite number of times? And the expected return is simply the expected profit divided by the expected risk. And then there's the annualized expected return, and that we'll see in a minute we can use to compare and contrast different strategies. And then the Greeks of this strategy. So this is based on a 10 lot. If I click on the magnifying glass, it brings up the details of the trade with of the spread with all the trades in it. I can go in here. I can change the quantity. Let's say I want to do 15 of them. It goes and changes it. Now you can see that I have a 1,005 credit, but that's also going to change the margin. So now I'm risking up to 15,000 or 16,000 with a 962 expected return. I'll go back to 10 here. So that's an easy way to edit the trade that you put on. A couple of people have asked, I'm just glancing over at the questions. This session is being recorded, and it will be available on the strategy zone. Not tonight, tomorrow or later this week. Okay, so we can do this naked put. There's also a lot of choices. You can change the graph so you can get a little bit better look at it. Depending on your screen, you might not have a lot of real estate. Usually, if I put it on my laptop, I end up collapsing a lot of things. But we might want to compare this to something else. So what else can we do instead of a naked put? Well, we're bearish on volatility, and let's say we're bullish on the stock because we're selling the put. We think it's going to stay at least over 75. That's a pretty far out of the money. That's almost $20 out of the money, but we're still getting a good credit for it. But that also, that high premium and a high implied volatility is an indication that the market thinks that this stock has a chance to go down that far. That's why people are paying a lot of money for they're paying a premium to buy those puts as protection. So maybe we want to hedge this a little bit. So what can we do aside from that? If we're really bullish, you could buy a call spread, a vertical spread. A couple of people asked about vertical spreads before. That's somewhere near the money. So let's say we wanted to buy we really think it's going to go up. We can buy the July, we'll do 10 lots, the 90-95 bull call spread, and see what that looks like. So I can click that on there, and we can see immediately, first of all, it's got a negative expected profit. So that makes me not want to go into this very much, but it's got limited risk, so we're only really risking about $2,800. The expected risk is a little bit less than that because we don't expect it to go because of the way the expected value is calculated. It's a statistical measure based on a volatility assumption. So we won't expect it to go all the way down to our low strike all the time over the infinite number of times that we're theoretically going to do this. So we can expect to lose about or risk $2,800, and we can make about, let's see, the maximum we can make is $2,200. To me, that's not a really good reward to risk ratio, but it's something else to compare to. We could also sell a put vertical. Let's say we want to sell the 90s and buy the 85s for July, a 10 lot to keep it even. So this is looking a little bit better. You can see that they're about to have the same sort of profile. We're taking in a $1,400 credit, but we can lose up to $3,600. So that's not really, that's not a very much better reward to risk ratio, but it's got a positive expected value right off the bat. So we can, it's just another trade that we can look at. And finally, one other thing we could do is buy an out-of-the-money butterfly. Let's say, we think it could go up to 100 by, do some technical analysis, and we can have a target price of 100 by July. I'm not saying that's what's going to happen, but we can do a 95, 100, 105 butterfly, a 10 lot, which is not big for a butterfly. And that's got a really good risk-reward ratio, and the upside, the break-even here is about 95.87, not too far away. And if we're really bullish on it, maybe that's not an unrealistic place to look. So the first thing we can do to do a comparison is we can sort these columns too, and sort that descending by the expected return. And so far, based on this analysis, the short put looks like the best thing, based on an expected return calculation. But we really haven't stressed the volatility yet. So one thing we can do is, for this, come back to the naked put. First of all, since we're naked, our margin might change as time goes on, and we want to see what it might look like at different points in time. So I can go to the calendar down here. Let's say I want to see what it would look like, next Monday. And what that does is it adds a line to the chart. It shows what the profit will look like. It added a line to the theoretical P&L matrix, which what this shows is on a given date, what's the expected profit, the expected risk, the expected return, and the theoretical P&L based on moves of -3 standard deviations to +3 standard deviations. And those are based on our volatility assumptions. And with this is, brings us to the third way that we use Option Workbench, which is to change our volatility assumptions. So I'll put a couple of more dates in here. We have a little bit more to look at. Here, I'll collapse this so we can see the graph. So here you get a good idea of what your profitability looks like under current volatility scenario on different dates, and it shows you the P&L matrix. The risk detail screen shows you what the numbers are based on moving around, what the underlying price is, just moving the cursor around. But what we really want to do is see what happens. Let's say we want to see a worst case scenario. What if there's a big spike in the volatility and the realized volatility, historical volatility, goes up to 50%, and the option implied volatility goes up another 10 points. What does that do to the trade? Well, that makes it a little bit worse. You can see that it brings down our expected return at expiration to $180. It's still positive, and we picked a good one because it's so far out of the money. But as our expected risk is going to go up because the implied volatility goes up, and the margin calculation that if you don't have portfolio margining, the margin calculation that the broker is going to use is going to take into account the premium of the option to figure out how much they want to hold aside for your margin. And you can do that for all the other spreads as well. You can put the dates in and stress the volatility. You can also look at a best case scenario. Okay, let's say we'll reset this to what it is at the market. Well, let's say the volatility comes down. It comes down to 20%, and then the IV of our option comes down 20 points, which there's some great news. The Eurozone is going to bail out Greece and Italy and Spain and Portugal and everybody's happy, and the whole world is going to be great again. What does that do to the trade? Well, that makes it pretty darn good. We're making money all over the place on this one. So this way you can test different volatility scenarios for each trade that you're looking at and decide based on your outlook on price and volatility movement and your appetite for risk, what's the best trade for you to get into. And just about up for the hour, so I'm going to go back to the presentation, and we'll wrap up, and then I'll take some questions. Okay, so as an incentive and a reward for sitting through this and listening to me drone on, we're offering a buy one month, get one free trial offer. That's $140 value for $59.90. And for the first 10 people to sign up for the excuse me, the buy one, get one free, you'll get a free 1-hour one-on-one live tutorial that will be able to customize to your trading style and what your appetite for risk is and what you like to do. And that you can follow this link, www.optionstrategist.com/OWB, and you'll be able to sign up for that free trial. Some upcoming new features. We're currently, we've pretty much decided on a data vendor. We're just trying to slot it into the schedule. We're going to automatically load, load on demand automatically the earnings history, forward earnings, and dividends, so that the calculate you won't have to add them manually. There's a way to to put earnings dates in and dividends in so that you can do different calculations. So that data will be available in an add-on package coming soon. And I also just want to do one more plug for the mentoring program. And just, Stan is a really great guy, and he really knows what he's talking about, and it helped me a lot. And I had, 20 years experience with the math and stuff behind this, building trading systems for, sell side and buy side, professional traders. If you want to get in contact with me, you can reach me at support@hillcosoftware.com. I love talking about options and Option Workbench, so send me an email, and you've probably made a new friend. The Option Workbench website is www.optionworkbench.com. It's actually right now under construction. There is a link to a brochure there that describes some of the features, but it's going to be a really cool website with educational material. There'll be recordings of different webinars on there that you'll be able to access. You can also access those on the optionstrategist.com, and there's a description of Option Workbench there at products, Option Workbench. You can contact McMillan at info@optionstrategist.com. And once again, to sign up for the webinar, it's optionstrategist.com/OWB. And at this time, I'll take some questions. I'll leave this contact information up so people can write down the information. Is this real time? Okay. The data is not real time at the moment. There is a way that you can change the prices. You can change the equity price, the underlying price, and the option, either the option price or the implied volatility, and everything else will be recalculated. You can do that on the pricing sheet, or you can do that in the spread. Excuse me. What I usually do is when I'm analyzing right before I do a trade, I will change the underlying price, and then put the trade in, and then change put the what the bid and ask is at the market right now. We are looking at other real-time data. It's from the same vendor, but that's going to be a little bit further down the road. There's a lot of additional cost with real-time data because you have all these exchange fees and things like that. And you get it from your broker because they're making a lot of money on the commissions that they charge. Once again, this session is recorded, and you'll be able to get it on optionstrategist.com in the next couple of days. Let's see. Jim asks how this tool compares to widely available generic tools like iVolatility. Well, I used iVolatility, the free one, and Option Workbench is way more dynamic than that. It's got the sophisticated filtering and searching, and I haven't seen one where you can do the kinds of scenario analysis, even the broker ones. Thinkorswim has good stuff. I use Thinkorswim, but it's the brokers want you to do trades as fast as possible and as many as possible so they can make the commissions. This is really right now it's pre-trade analysis. You really have to know what you want to trade and make good decisions. It's just cliche, but you need to make the money before you trade. So let's see. Can you use a volatility study to look at close to next day open? Not sure what this question means. The volatility study is close to close. We are thinking about putting some more sophisticated technical analysis tools in there, but that would be a long-term thing. Okay. Jim asks about training. If you want training on volatility, then I would highly recommend the McMillan mentoring program. It's you can read some of Larry's books too. Options as a strategic investment is sort of like a reference guide, but there's another book, Macmillan on Options, which is really good. And I call the Venerable Chapter 6 in that book. Talks a lot about volatility training. Do I have a course to go along with OWB? The course is really going to be in the form of the online tutorials and webinars that are going to be on the website. So there will be, for all the sections, the 3 sections that I covered tonight, there's going to be a little bit more detail in sort of 5 to 10 minute vignettes on the website when it's ready. And we're expecting it, by the end of the summer at the latest. It'll all be up there. Okay. Weighted put call ratios are not available yet. The data is there. Is there to be calculated. It's on the development queue. There's a lot of things. There are a lot of things on the development queue. I don't really have a time frame on when those will be available yet. But working on the put call ratios is definitely on the queue. Let me go back a little bit. Today. Okay, someone asked how the expected return is calculated. That's what it does. The expected return is the expected profit divided by the expected risk. So those are 2 expected value calculations. So in general, an expected value calculation takes a series of prices from -3 standard deviations to +3 standard deviations from the current price, and obviously that depends on the volatility which you set. And then it takes small increments of the price between each of those and calculates the value of the spread at each one of those underlying prices. And then it assigns a probability based on the log normal distribution to each one of those prices happening, and multiplies the theoretical P&L at that price times the probability, and then adds all those numbers up, and that's your expected value. That's the general way of doing expected value. There are lots of different distributions that you can use. There's a fat tail distribution. There are other distributions that you can use to calculate that. But that's in general, without going into too much detail, how the expected values are calculated. Okay, I think that's about it for the questions. Some more questions? Okay, well then, thank you all for coming. I appreciate your spending your time. Oh, here's another one. The promotion, if you go to, this link, I'll put this up again, optionstrategist.com/OWB. There should be a link there. They told me there was tonight. I'm not sure. It might not be up yet, but it should be tomorrow. If you don't see it tonight, it'll definitely be there tomorrow. I'll make sure that it's there, and it'll be first come, first serve. Thank you for the compliment, Ray. Yeah, I guess. I mean, yes, Ken. If since you attended the webinar, I guess you're entitled to doing the promotion again. Okay, well, thank you all for coming, and I hope to speak to you in the future. Have a good night.
The organizer has ended the session, and this